Three banks didn't just fail this month. They were erased. And the people who had money in them found out the same way you find out a restaurant is closed. They showed up and the doors were locked. Let that sink in for a second. You wake up on a Tuesday morning. You go to check your account. And there's an FDIC notice where your bank used to be. This is not a hypothetical. This is not a worst-case scenario somebody cooked up in a newsletter. This happened in 2026 to real depositors, real business owners, real people who had no idea the institution they trusted was sitting on losses so large that regulators had no choice but to pull the plug. And here is the part that should make every single person watching this video deeply uncomfortable. The three banks that just failed were not the weakest ones. They were not the most obvious candidates. There are institutions right now, ones with clean websites and friendly branch managers, and we've been serving our community since 1987 plaques on the wall, that are carrying losses they have not told you about, and the clock on those losses just ran out. So before we go anywhere, I want to ask you something genuinely. Do you actually know what kind of bank holds your deposits? Not the name on the app. I mean, do you know their commercial real estate exposure? Do you know what percentage of their loan book is tied to office buildings that are now 30% empty? Drop your answer in the comments. I'm serious, because what I'm about to walk you through is going to completely change how you think about that question. Let's start with something most financial content completely ignores, because they assume you already know it. You don't bank with JP Morgan. Most Americans don't. The institution that holds your checking account, funds your local business loan, and processes payroll for your employer is almost certainly a regional bank, one of over 4,500 lenders across America with assets under $100 billion. These are not household names. They don't have trading desks in Manhattan. They don't have armies of lobbyists. They are, in the most literal sense, your neighborhood's financial infrastructure. And here is the number that changes everything. Regional and community banks hold approximately 70% of all commercial real estate loans in the United States. 70%. Not the big guys. Not the ones that get bailed out on the front page of every newspaper, the regional lenders, the ones that nobody talks about until the FDIC shows up with a resolution plan and a press release that goes out on a Friday afternoon when they hope nobody is watching. These banks are not diversified. They didn't build derivative desks or asset management divisions to offset their loan book exposure. They made a bet, concentrated geographic sector-specific bets, on commercial real estate, office buildings, retail centers, multifamily developments. And for a decade, that bet paid off beautifully, until it didn't. Now let's talk about the three banks that just failed, because I want you to understand exactly what happened, not as a headline, but as a mechanism, because mechanisms repeat. The first institution was a mid-sized regional lender operating across 3 Sunbelt states. Total assets just under $4 billion. On paper, it looked fine 18 months ago. Its non-performing loan ratio was within regulatory tolerance. Its capital ratios passed the stress test. But buried in its call report data, the quarterly filing that banks submit to regulators and that almost nobody reads, its commercial real estate concentration ratio was sitting at 387% of Tier 1 capital. The regulatory threshold that triggers heightened scrutiny is 300%. This bank was 87 points past the red line, and it had been there for 2 years. What finally broke it was a single office park in suburban Atlanta. $42 million in loans. The property appraised at $26 million in a forced liquidation. The bank ate a $16 million realized loss in a single quarter, and the capital position that looked adequate yesterday looked catastrophically thin today. The second failure was different in geography, identical in disease. A community lender in the Midwest, the kind of bank that sponsors Little League teams and has its CEO's photo in the local paper every year. This one had concentrated exposure to suburban retail strip malls, the kind of centers anchored by a grocery store and filled with businesses that have been quietly dying since 2020. What killed this bank was not a single bad loan. It was the quiet accumulation of 100 decisions made between 2018 and 2022, when cap rates were low, valuations were high, and everybody assumed the music would keep playing. The music stopped. The deposit outflows started 6 weeks before the failure, small at first, then accelerating as word got around that examiners had been in the building. By the time the FDIC announced resolution on a Friday evening, the sophisticated depositors had already moved. The ones who got hurt were the ones who trusted the name on the door. The third failure is the one that should genuinely disturb you. This bank had passed its most recent regulatory stress test, clean bill of health. 12 months later, closed. How does that happen? It happens because stress tests model scenarios, not reality. They assume a certain pace of deterioration, a certain level of loan defaults, a certain path for interest rates. What they do not model well is the moment when a critical mass of commercial real estate loans in a single geographic pocket all hit maturity simultaneously. None of them can be refinanced at current rates, and the borrowers simply walk away. That moment arrived for this institution in the first quarter of 2026, and no stress test had flagged it because the inputs weren't designed to capture a cliff edge. They were designed to capture a slope. Here's something I want you to genuinely think about for a moment. Every one of these failures was visible in the data before it happened. The call reports are public. The concentration ratios are public. The FDIC's problem bank list, which currently shows numbers not seen since 2013, is public. The question is never whether the information exists. The question is whether anyone is paying attention to it before the doors close. That's why you're here. So let's keep going. To understand why commercial real estate is destroying regional banks right now, you need to understand the mechanics, not in theory, but in a way that actually lands. So let's walk through it. Imagine a regional bank made a $50 million loan in 2019 on a suburban office campus. The building was 80% occupied. The borrower was a solid developer with a track record. The loan was underwritten at a 4.5% cap rate, which was completely standard at the time. Fast forward to 2026. That same building is now 51% occupied because 3 of the anchor tenants downsized after their leases expired and their employees never fully came back to the office. The appraiser comes in and values the property at a 6.5% cap rate, because that's where the market is now with elevated interest rates, and the valuation comes out at $31 million. The bank has a $50 million loan on a $31 million asset. That's a $19 million hole, and the borrower cannot refinance because at current rates, the debt service on a new loan would exceed the property's net operating income. So the borrower hands back the keys. This scenario is not hypothetical. It is playing out across thousands of loans right now. The national office vacancy rate hit 19.8% in Q4 2025, the highest number ever recorded. And the critical thing to understand about that number is that it is not going back down. This is not a cyclical problem waiting for the economy to recover. The structural shift in how people work, hybrid schedules, reduced footprints, lease contractions, is permanent. The demand that justified those 2019 valuations is gone, not temporarily suppressed, gone. And here's where it gets mechanically brutal for the banks. When a bank takes a $50 million loss on a CRE loan, the damage doesn't stop at $50 million. To maintain its capital ratios, the regulatory requirements that determine how much it can lend, the bank must shrink its entire loan book by 8 to 10 times the loss amount. A $50 million hit pulls $400 to $500 million in lending capacity out of the local economy. Businesses can't get credit lines renewed. Construction projects stall. Small businesses that depended on that bank for working capital start hunting for alternatives that don't exist at the same terms. The loss at the bank becomes a contraction in the real economy. And a contraction in the real economy means more defaults, which means more losses. You can see where this goes. There's a term that gets used in banking circles that I want you to understand because it explains why the failures we've seen so far are the beginning and not the middle. The term is extend and pretend. It means exactly what it sounds like. Instead of recognizing a bad loan as a loss, which would force a write-down, which would destroy capital ratios, which would potentially trigger regulatory action, the bank simply extends the loan maturity, gives the borrower another 12 or 18 months, lets the bad debt sit on the books at face value while the underlying asset continues to deteriorate, defers the reckoning. Banks have been playing this game with commercial real estate loans for 2 years. And for 2 years it has worked, in the sense that it has prevented formal recognition of losses that are economically real but not yet legally acknowledged. But extend and pretend has an expiration date. That date is the maturity wall. Over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. Not over a decade, not over 5 years, 18 months. When a loan matures, the borrower has to either repay it, refinance it, or default. In 2019, refinancing was easy. Rates were low, valuations were high, lenders were hungry. In 2026, refinancing at current rates on a property whose value has dropped 30 to 40% is mathematically impossible for most borrowers without injecting fresh equity. Equity that doesn't exist, so they default, and the bank can no longer pretend. The extend game ends, and the losses become real, all at once across the entire portfolio in a compressed 18-month window. This is not speculation about what might happen. This is arithmetic about what must happen given the existing stock of loans, their maturity dates, and current market conditions. Quick question, because I genuinely want to know your read on this. Do you think regulators actually have a handle on how bad this is? Or do you think they're managing the disclosure the same way the banks are managing the losses, slowly, strategically, hoping it doesn't all land at once? Comment below. I read these. Now let's talk about history. because the people who will get hurt worst by what's coming are the ones who think this is unprecedented. It isn't. We've seen this movie twice before, and both times the ending was the same. The savings and loan crisis of the 1980s and early 1990s is the closest structural parallel. Savings and loan institutions, the regional lenders of their era, made concentrated bets on real estate during a period of loose regulation and cheap money. When interest rates spiked under Paul Volcker and property valuations collapsed, the losses were catastrophic. Over 1,000 institutions failed between 1986 and 1995. The total cost to taxpayers exceeded $130 billion, over $300 billion in today's money. But here is the detail that most people never hear. Regulators knew the problem existed for 2 to 3 years before the failures cascaded. They allowed extend and pretend. They managed the disclosure. They hoped the problem would shrink on its own. It didn't. It grew. And when it finally broke into the open, it broke all at once. The second parallel is Japan. In the early 1990s, after Japan's real estate bubble burst, the country's regional banking system was sitting on catastrophic losses tied to commercial property. Rather than force immediate recognition of those losses, which would have required painful bank recapitalizations and politically difficult restructurings, Japanese regulators allowed banks to carry impaired assets at inflated values for years. The result was a decade of economic stagnation, zero growth, zero credit expansion. A generation of businesses that couldn't access capital because the banking system was technically alive but functionally paralyzed. They called these institutions zombie banks. Banks that were breathing but not actually performing the function of a bank. What's different in 2026, and this is the part that keeps me up at night, is that the structural demand destruction in commercial real estate is worse than anything Japan faced. Japanese property values eventually recovered because the underlying demand for commercial space was still there. The work-from-home shift in America has permanently altered the demand equation for office space. You cannot wait for a recovery in office occupancy the way Japan waited for a recovery in land prices. The occupancy is not coming back, the valuations are not mean reverting, the losses are permanent, and the banks holding them are still pretending they're not. Let's talk about contagion, because the 3 bank failures this month are not isolated events. They are the first cracks in a wall that has been absorbing pressure for 2 years. Here's how the contagion actually moves, because it doesn't happen the way most people imagine. It's not just depositors panicking. The transmission channels are more structural than that. The first channel is loan participations. When a regional bank makes a large CRE loan, say a $60 million deal, it often can't carry that exposure alone. So it sells participations to other regional banks, 5, 10, sometimes 15 institutions sharing a single loan. When that loan defaults, the loss doesn't hit one bank. It radiates across the network. 3 failures this month means the participation losses are spreading to institutions that had nothing to do with originating the bad loans. The second channel is deposit contagion, and this is the one that moves fastest. A depositor in an uninsured account, anyone with more than $250,000 at a single institution, watches the news, sees a bank failure in their region, and moves their money the same afternoon. They don't wait for an FDIC announcement. They don't wait to see their institution's capital ratios. They move. And digital banking means that a bank run that used to take days to develop now happens in hours. The 3 banks that failed this month all showed accelerating deposit outflows in the 6 to 8 weeks prior to closure. The smart money moved, the uninformed money stayed. The third channel is the one nobody talks about: correspondent banking. Regional banks rely on larger institutions to provide services: check clearing, wire transfers, foreign exchange, securities custody. When a regional bank starts showing stress, its correspondent bank pulls back, tightens the terms, raises the collateral requirements, reduces credit lines. The regional loses operational capacity, even if its own balance sheet technically hasn't crossed any regulatory threshold yet. It becomes functionally impaired before it becomes formally impaired. The geography of this contagion is not random. The highest risk clusters are Sunbelt metros that overbuilt during 2019 to 2022, Austin, Nashville, Charlotte, where office supply expanded aggressively right before remote work permanently compressed demand. Secondary Midwest markets, Columbus, Indianapolis, Kansas City, where the regional bank concentration is high and the institutional sophistication to hedge the exposure is low, and coastal suburban corridors where companies downsize their satellite offices first, leaving suburban campuses half empty and loan collateral values in free fall. The FDIC's problem bank list, which does not disclose individual institution names but reports total assets and counts, is currently at levels not seen since 2013. 16 institutions are being watched closely enough to be on that list. 3 of them were on it when they failed this month. Now let's be honest about the Federal Reserve's position, because I want you to understand why the cavalry you're expecting is not coming in the form you expect it. The Fed has tools. The discount window, the Bank Term Funding Program, which has been extended 3 times since it was created as an emergency temporary measure in March 2023, which tells you everything you need to know about how temporary the emergency actually was. Emergency liquidity facilities that can be activated if the situation escalates. But every one of these tools comes with a cost that is getting harder to pay. If the Fed cuts rates aggressively to ease pressure on bank balance sheets and help CRE valuations recover, it risks reigniting inflation that is still above target. If it keeps rates elevated to finish the inflation fight, the commercial real estate losses continue to compound and more banks fail. There is no clean exit from this position. There is no rate decision that solves the problem without creating a different version of the same problem. The political environment makes it worse. After 2008 and 2020, the public appetite for anything that looks like a bank bailout is at historic lows. Any intervention perceived as protecting bank shareholders, as opposed to depositors, will face immediate congressional backlash. So the Fed is threading a needle, using the BTFP and the discount window to quietly support liquidity, allowing orderly failures through the FDIC resolution process and hoping the math stays contained. Controlled demolition. Remove the weakest structures before they can fall on the others. The risk of that strategy, and any structural engineer will tell you this, is that controlled demolitions require precise knowledge of where the load-bearing elements are. If you're wrong about which walls are structural and which ones are decorative, the controlled demolition becomes something else entirely. All right, here's where this gets practical. Because everything I've walked you through leads to one question. What do you actually do with this information? The first play is so basic that most people skip it, and that's exactly why it matters. Audit your deposit exposure tonight. Know which institutions hold your money. Know your FDIC coverage. The limit is $250,000 per depositor per institution per account category. And that last part is important because account structuring across ownership categories can legally extend your coverage within a single institution. Joint accounts, individual accounts, retirement accounts, they each carry separate coverage. But if you're sitting on $600,000 in a single checking account at a regional lender with a 380% CRE concentration ratio, you have $350,000 in an uninsured position at an institution with identifiable stress. That is not a risk you are being compensated for. That is a risk you are carrying without knowing it. For businesses and high net worth depositors who need to maintain large balances, the IntraFi network, formerly known as CDARS, allows you to spread deposits across hundreds of member institutions through a single banking relationship while maintaining full FDIC coverage on the entire amount. This is not exotic. It is not complicated. It is a service that exists specifically for this scenario and that most depositors have never heard of. Look into it this week, not next month. This week. The second play is the barbell. Maximum liquidity on one end, zero counterparty risk on the other, and nothing in the middle that depends on an institution's solvency to remain whole. On the liquidity end, 4-week and 13-week Treasury bills purchased directly through treasurydirect.gov. No bank intermediary, no brokerage custodian. A direct claim on the United States government that settles to your designated bank account at maturity. In a banking crisis, this is the asset that has no counterparty risk below the federal sovereign level. The yield right now is competitive with savings accounts. The safety profile is incomparable to any bank deposit above the FDIC limit. On the zero counterparty end, physical gold and silver. Not ETFs, not allocated accounts at a bank that might itself be failing. Physical metal in your possession or in fully segregated non-bank storage. I know this sounds old-fashioned. I know it doesn't show up in a brokerage dashboard. But here is the historical reality. Every time there has been a banking crisis in modern history, 2008, 2020, 2023, gold initially dipped as institutions liquidated everything to raise cash, and then ripped higher as investors fled into assets with no counterparty. The pattern is consistent enough that it is not a pattern anymore. It is a playbook. The time to read the playbook is before the game starts. For most investors, a 15 to 20% allocation to physical precious metals in this environment is not aggressive. It is defensive. The question is not whether you can afford to hold gold. The question is whether you can afford not to. The third play is for people with higher risk tolerance and genuine conviction about timing. Regional bank equities are going to get destroyed as this crisis deepens. Not all of them permanently. Some institutions have fortress balance sheets, low CRE concentration, and the liquidity to survive and acquire failing competitors at pennies on the dollar. But the sector as a whole, expressed through ETFs like KRE and KBE, will reprice dramatically lower as losses are recognized and contagion accelerates. In March 2023, during a regional banking stress event that was significantly less severe than what the data suggests is coming, CRE fell over 30% in weeks. The discipline here is to wait for the forced liquidation moment. Do not try to get cute with the timing. Wait for the repo rates to spike. Wait for the FDIC announcements to start accelerating. Wait for the Fed to announce emergency measures, then deploy into the highest quality names at the lowest prices. This is Warren Buffett's playbook from 2008 when he bought Goldman Sachs preferred shares at distressed prices and generated billions in returns. You don't need to be Warren Buffett to understand the strategy. You need the patience to wait for the right moment and the conviction to act when everything feels the most uncertain. Let me give you the 5 signals to watch, the actual data, all of it public and free, so that you are not dependent on headlines to know what's happening. The first is the FDIC problem bank list, published quarterly. Watch the direction. A rising count is the early warning, not the absolute number. The second is the Federal Reserve's H8 data release, published weekly, which tracks deposit flows at commercial banks, broken down by institution size. Sustained outflows from small and mid-sized banks that don't show up at large banks are a systemic warning signal. The third is the KRE to KBE spread. When regional bank stocks are underperforming large banks by an accelerating margin, the market is pricing in sector-specific stress before it shows up in official data. The fourth is the CMBS delinquency rate published monthly by TREP, specifically the 90-day bucket, which is where realized losses start flowing to bank balance sheets. And the fifth, this one almost nobody watches, is the FDIC's Deposit Insurance Fund Reserve Ratio. The fund currently holds roughly $117 billion against $9.9 trillion in insured deposits. That is a 1.17% coverage ratio. If it drops below 1.15%, the FDIC is legally required to develop a formal restoration plan. Watch that number. 3 bank failures already moved it. 16 more on the watch list will move it significantly further. You do not need a Bloomberg terminal to track a banking crisis in real time. You need 5 bookmarks and the discipline to check them once a week. Here's where I land on this. 3 banks failed this month. The mechanism is commercial real estate, the contagion channels are open, the maturity wall is real, it is dated, and it is 18 months from forcing recognition of losses that the banking system has been carrying in silence for 2 years. The Federal Reserve is constrained. The FDIC's buffer is thinner than you think. And the institutions at highest risk are concentrated in the geographies and asset classes that look most familiar on a map of American regional banking. The number I want you to walk out of this with is 70. 70% of all commercial real estate loans in America are held by regional banks. If commercial real estate losses continue to accelerate, and the math of a $1.5 trillion maturity wall says they will, the sector carrying 70% of that exposure cannot outrun the arithmetic. The 3 banks that failed this month were not the end of the story. They were the first chapter. The question is not whether you're going to read the rest of it. The question is whether you're going to read it as a spectator or as someone who already repositioned. Audit your deposits tonight, build the barbell, set up the dashboard, and for the love of everything, stop assuming that because a bank has been on your street corner for 30 years, it will be there tomorrow. The 3 banks that closed this month had been on their street corners for a very long time too.